And so the more money that gets converted from fiat into Bitcoin, then some of it trickles down to the other parts of the ecosystem. And it's, rising tide lifts all boats.
Yep.
So a fair value of BTC today, somewhere in the low 50s, according to the, Tim Peterson model, based on Metcalfe's law, which I think is the best model out there. Let's round it to 50 to be conservative. That doubles to 100 in April, May next year.
This content is brought to you by Uphold, which is a great crypto platform that I've been using since 2018. Uphold has all the top cryptocurrencies, Bitcoin and all the altcoins. In fact, they have 260 plus cryptocurrencies on their platform. You can also trade precious metals, stablecoins, and 37 fiat currencies. In addition, they are available in over 150 countries. And this platform is fully reserved. They do audits, so you can trust that your funds are safe, no commingling, no lending out your funds. If you'd like to learn more about Uphold, please visit the link in the description. Welcome to the Thinking Crypto podcast, your home for cryptocurrency news and interviews. With me today is Mark Yusko, who's the founder, CEO, and CIO of Morgan Creek Capital Management. Mark, great to have you back on.
No, thanks for having me back. Looking forward to the conversation.
Yeah, Mark, I always, put you on the calendar that I got to talk to you maybe every quarter or every 6 months, because you have such a great perspective on the markets. So let's start with the macro. Let's set the table. Yeah. We are hearing that the Fed seems to have paused interest rate hikes, and there are Fed futures anticipating cuts coming next year in May. What are your thoughts? Are we at the tail end of quantitative tightening?
Well, now there's a bunch of questions in there that are interesting in the sense of, I thought you were going to say, are we on the tail end of short-term rate hikes? That looks to be the case. It looks like there may not be any more short-term hikes. Quantitative tightening, though, is still alive and well. What's really interesting is if you look at the Fed balance sheet, it actually is shrinking. Now, it needs to shrink, right? They made, I believe, maybe the greatest policy error of all policy errors back after the lockdowns in 2020, where they doubled the money supply over an 18-month period. I mean, just absolute insanity. And what people call inflation, to me, isn't. It's just currency devaluation. We just devalued the currency by 50%. And that was crazy. And so they're trying to clean that up. And so quantitative tightening actually is alive and well. In fact, for the first time in 100 years, just let that hang there for a second. 100 years, we've expanded the M2 money supply. Every month, month in, month out, on average, about 7.5%. I mean, that's crazy. So for the first time, we are now contracting the M2 money supply. So I think it's an interesting dynamic. The bulls are out saying, look, Fed fund futures are predicting, rate cuts next year.
Right.
Well, why would they cut rates? Let's think about this. Only if the economy was sucking. That's a technical term. So otherwise, why would they cut rates? What I think people are confused by is most market participants today grew up in this era of craziness, right? Zero interest rates.
Right.
And they think that's normal. It's not normal, right? We had a 10-year period following the global financial crisis, and we had about a 7-8 year period in the late 30s and early 40s. That's it. The rest of the time, rates average somewhere between 5 and 7.5% on the short end. And this idea that we're suddenly going to go back to zero rates just doesn't make any sense at all. Capitalism doesn't work at zero rates, right? There has to be a premium paid to lend your capital to someone or to invest your capital in equity, you have to have a return on that invested capital. So yes, people are excited that, people are predicting Fed cuts next year. But here's the crazy thing. For 13 years, from 2009 to 2000, I guess for 12 years, to 2021, people anticipated that they would raise rates, and they never did, right? And so that group of people that are the experts have not been right. And when it's the Fed leading that charge, they're never right, right? Their own expectations of things like CPI and rates is always off.
So do you believe that they will maintain rates at a certain level? Maybe they cut. Do you think they cut maybe just a margin and, maybe it sticks at 3% and that's there for a few years? I don't know. And the markets and the economy can keep, maybe go back into or keep growing. That will be normal, as you said, because we have been so spoiled with with very low rates, a lot of liquidity, QE, a long era of a QE that we're not used to this.
Look, I don't think we're going back to emergency liquidity measures, right? I don't think we're going to have another emergency like the global financial crisis. I think we're going to have a pretty meaningful slowdown. PMIs have rolled over hard. Employee or consumer confidence has rolled over hard. There are a lot of things that are pointing to much lower economic activity next year. And I think that may push the Fed to act. I don't think they're going to act very much because I don't think it's going to be this big deleveraging like we saw in the global financial crisis. We had the third largest bank failure in history earlier this year with Silicon Valley Bank. And people brushed that off like it was nothing. Now the Fed, threw $300 billion into the markets overnight and kind of saved everybody and guaranteed all the deposits. And that was the reversal of almost a full year of QT in 2 days. But now they've pulled that back out. They went back to quantitative tightening. So look, at the end of the day, higher rates are necessary for the banking system to flourish. The reason we had low rates for so long was we were basically trying to re-liquefy a bankrupt banking system. The banking system in the global financial crisis got out over their skis. They got too much leverage. They collateralized a whole bunch of crappy, again, another technical term, assets in the form of subprime mortgages. And everybody lost a lot of money. And the banks were basically bankrupt, right? Citigroup stock was down 99%. JP Morgan was down 95%. And they all should have gone to zero. But as one of our managers, Chase Coleman at Tiger Global, said, it was inconvenient for too many people for those stocks to go to zero. So they didn't go to zero. And by saving them, by bailing them out, by giving them $700 billion of taxpayer money to bail them out at the bottom, then we had to re-liquefy their balance sheets. Well, how did we do that? Well, you let them borrow from the Fed at zero. Because I don't know about you, but I never got to borrow at zero. Fed funds, I don't get access to that. So it was only the banks. The banks borrowed at zero and they bought treasuries. And that was a great trade. You made 3% risk-free and you could lever it up 10 times and have no down trading days. But then Jerome Powell comes along last year in 2022 and says, party's over. I'm raising rates. And so all these banks that got stuffed with those bonds lost it, right? Consumer banks, regional banks, some of the big banks, not the big banks, right? They were protected and they were bailed out with the emergency financing from the Fed. And then shockingly, JP Morgan got to buy all the good assets from the bankrupt companies, which they always do. Look at Washington Mutual, look at Bear Stearns. It always ends up at JP Morgan. So now we're at this point where short-term rates are higher. They're still not paying depositors very much. I don't know if you looked at your deposit rate lately. It's still 0.5%, 1%. So they're lending at 4 or 5 or 6 or 7. They're paying 1. That's a net interest margin that's really high. So bank profits were doing pretty well. Bank stocks were up for a while. Then they kind of crashed because people got worried about an imminent recession, and stocks started to roll over in the summer. And then we got to November. And in November, everything's sunny, right? Stocks are up 10%, everything's rallying, bonds are up, rates are down. Well, what changed? Well, what changed is every November. So there's a rule that happened back many, many years ago that changed the fiscal year end for mutual funds. So they used to trade on 12/31 year end, and then they changed it to 10/31. So mutual funds have to unload all their trades before 10/31 in order to qualify for the current tax year. Well, why does that matter? Well, in the old days, all the tax loss selling, all the bad stuff that happened would get liquidated at the end of the year.
Right.
And then there was this thing called the January effect, because you have to wait 30 days to buy back the thing that you just sold. And so everyone would unload in early to mid-January, in December. Then they would buy back in mid-January. And the worst performing things the previous year would do the best in January. And it was usually small cap stocks, and they called it the January effect. Well, then it disappeared 20 years ago. Well, why did it disappear? Well, it didn't disappear. It now just happens in November. So if you look at all the worst areas from the beginning of the year, okay, biotech and healthcare and all these things that were doing terrible, they've crushed it. Small cap was up 5% the other day in one day. Everyone's about the Nasdaq's up 2.5. Small cap was up twice that. So all of this stuff was dumped in October. They waited their 30 days and they started buying it back here in November. So that November effect gives people this false sense of security. They call it the Santa Claus rally, and Santa Claus came early.
Yeah.
Well, it's not Santa Claus. Santa Claus actually doesn't exist. I hate to break to everybody, but it's the mutual funds buying the assets that they sold 30 days ago. And because of that, you get this, animal spirits, and people get ebullient again. And then they start looking at, oh, well, the Fed's going to cut rates next year, and the bull market's back on. Okay, but let's look at data. Let's look at, how are travel data? How are the airports? How are the hotels? How are the airplanes? Are they still full like they were in the summer? Are they starting to be empty? I was talking to someone the other day, said they're on a plane with 20% full. 20%. When was the last time you were on a plane with 20% full? I mean, that's different. Restaurants, not as full as they were. So there's signs of slowing. We just had retail sales fall for the first time in 7 months, and 7 of the 12 sectors were negative. So there's signs that things are starting to be down a little bit. And the thing that I look at is the only way people were still spending in this environment was credit card debt, right? So everyone termed out their mortgage, and that was great. So now no one can move. So we've got the lowest turnover in housing in the last 100 years, sub 1%, because no one can afford to move.
Right.
So if you can't, but you have a lower mortgage payment, so you feel a little more flush. So then they went out and spent that over the summer. Well, that's kind of run out. And so now what do you do? Well, now you start spending on credit card. And credit cards went up. Credit card debt went up. Student loan debt, they started having to repay the loans again. And that windfall went away. Well, now credit card delinquencies are rising. And all of that points to, a slower economy and slower. So I think the macro, to me, tilts dangerous, not critical, not, crash tomorrow, but I think tilts dangerous. And I think Stanley Druckenmiller was on TV the other day saying that, he's as nervous as he has been in a long time, mostly because the government has a spending problem, and they keep approving more money to these foreign wars, and they can't balance their budget, and yet nobody's around to buy the treasuries. And probably the scariest chart I've seen in a long time was the chart of debt maturing in the next 12 months. A third of the outstanding, 25% of the outstanding debt, 8.4 trillion. Let's let that number hang there for a second. 8.4 trillion has to be refinanced over the next year. And it's going to go from zero to no interest rate to a big interest rate, probably 3, 4, 5%. That's going to put even more pressure on the budget and more pressure on fixed income. So I don't know. I probably cheat defensive here rather than offensive.
Sure. So, obviously we're talking probability. So you're thinking there's a higher probability of a hard landing versus a soft landing. And maybe to what we were discussing earlier, maybe they turn on the money printer to help solve that problem.
Yeah. Yeah. Look, I think they're between a rock and a hard place. I really do. I think they realize the error of their ways, thankfully. Why anyone listened to Stephanie Kelton in the first place, I'll never know. You can't print as much money as you want and have no impact. And housing affordability has vanished, right? The average person, my kids' generation can't afford a house. And it's the worst on an affordability basis that it's been, I think, ever been in the last 50 years. And so, that's a problem. And I just think, can the Fed turn the money printer back on in a world where there's too much money sloshing around?
Sure.
I don't know. I'm going to take the under. I'm going to say that rates are going to stay higher for longer. Things are going to get slower for longer. Not a disaster, not a depression, but slower. Kind of like the 01-02 period, where was pretty ugly. A lot of companies had to default. Bad companies went away because they couldn't refinance their debt. That's good. It's healthy. The period of time post-global financial crisis where every company was allowed to survive, that's not healthy, right? It's like having no cuts on a sports team. Makes everybody feel good, but you end up not doing very well. You end up probably injuring some people because they probably shouldn't be, playing if they're not skilled. And, life is about competition and not everybody winning. So getting back to a world where cost of capital is real and the Fed doesn't just hand out free money to everybody, probably a good thing.
Yeah, for sure. So with that said, what are you anticipating as far as performance for the stock market? And of course, the crypto market is correlated to the stock market. What are you anticipating for 2024?
So the good news is digital assets in the stock market aren't correlated at all, right? They actually went to negative correlation here recently. And the long-term correlation of let's just take Bitcoin to the S&P is 0.15. And it had one small period during the liquidations in 2020 when it went up, but that's the nature of liquidations, right? You don't get to sell what you want to sell, you sell what you can sell. And so all correlations go to 1 during liquidations of margin. So we're back to a period of low, I won't say negative, but low correlation. And so look, I think stocks are going to struggle. I think, this rally probably goes longer than people think, but then, they're going to have to pay the piper and they're just pulling forward future demand. And, I think next year is going to be meaningfully tougher. But that said, I'm really excited about what's about to happen in the digital asset space because of supply and demand. Right? We got the Bitcoin ETF, which is going to be approved. BlackRock's going to get approved. And whether anyone else gets approved, I don't know. I'll take the under, but hopefully, I own pieces of 21 shares and Bitwise. I hope both of them get approved. They're both ahead of BlackRock in line, but I'm a betting man, and I would bet both of them get denied, and BlackRock gets approved. That approval is going to unlock $30 trillion of assets in financial advisors who are not allowed to buy digital assets. And if their clients say, I want 10 basis points, that's 30 billion. If they say, I want 100 basis points, 1%, which is not even a lot, that's 300 billion. Bitcoin trades about 100 billion on average. About 600 billion is mostly hodled. So if 300 billion comes in on 100 billion of free float, that's a big move. From there, you've already seen a lot of things catch a bid. Solana's on a tear here. Ethereum's been rallying, still lagging Bitcoin, but it's been rallying. And ultimately, the halving cycle is destiny, right? When the halving cycle occurs, and the halving occurs next April, the block rewards get cut in half for Bitcoin, and the price of Bitcoin basically has to double. Right. So, well, why does it have to double? Well, if it didn't, then the miners would all go out of business, and we can't have the miners all go out of business. So it's kind of a built-in mechanism for increasing the price. Well, why does that matter? Well, an increasing price attracts activity, attracts notice. And so the more money that gets converted from fiat into Bitcoin, then some of it trickles down to the other parts of the ecosystem. And it's, rising tide lifts all boats. Yep. So a fair value of BTC today, somewhere in the low 50s, according to the, Tim Peterson model, based on Metcalfe's law, which I think is the best model out there. Let's round it to 50 to be conservative. That doubles to 100 in April, May next year. We shoot right through fair value in these, crypto falls. That we're in crypto summer now till next June. Then we go to crypto fall from June to June following the halving. Then we go to another crypto winter, but that's a long time from now. But in crypto fall, on average, we've rallied about 2.5 times fair value. I don't think that happens this time. I think partly the law of large numbers, partly not as much leverage in the system. So, do we get 1.5, 1.75, 150, 175? Maybe we could get to 200K. I'm going to take the 150 number. Seems like a logical place for us to be sometime in 2024.
Wow. Okay. But that was going to be my next question. If you anticipate that's going to happen in 2024 or 2025, just, following the 4-year cycles. So it sounds like 2024, and we start the correction maybe in 2025.
Yeah, look, June 25, we likely, or fall 2025, logic would say we get too high and then we correct. And why do we get too high? Because the speculators come in and the gamblers come in and people lever. But if there's not as much leverage this time, then maybe you don't correct as much. But ultimately, we'll go to excess and we'll need to correct. How much we have to correct, I think, depends on a lot of things. Look, if the big boys are here and have decided that, choke point 2.0 really didn't work, they tried to kill it. The thing is, you can't kill the technology. Right. You can delay the adoption by, making the on-ramps and off-ramps difficult, or, trying to legislate your way to make it challenging for businesses. But at the end of the day, name a technology that a better one came along and it survived, right? I went to New York yesterday for a couple hours for a conference, and I didn't take a stagecoach. I didn't take a horse and buggy. I didn't take a train. Took an airplane, right? And, this horse and buggy replaced the stagecoach, and then the automobile replaced the horse and buggy, and then the train, was better. And then, ultimately the airplane came along and it's better. And, someday they say there'll be a Hyperloop. There probably won't, but the airplane's just fine. And I don't think teleportation is going to work either. But I saw that movie once where they showed people teleporting, and they'd come back and there was like a glitch where they got stitched back together. I don't want glitches. I like my body the way it is. So technology is evolving, and digital technology is here to stay, and blockchains replace trust with truth. Truth is better than trust. And the banking industry has relied on trust for 800 years. They've had a good run. It's coming to an end. It won't end tomorrow, but ultimately, we can all be our own bank. We can own our own assets. We can own our own identity, our sovereignty. And we can actually, look, the key word in the white paper is peer-to-peer, right? Hyphenated. Or 3 words, if you want to call it 3 words, or 2 words, peer-to-peer. But the reality is that's the key. What does that mean? It just means that I can send you value without an intermediary.
Right.
Right now, you have to have a bank account. I have to have a bank account. I send you a wire or a Venmo or something. And that's the funny thing about fintech. There's no tech, right? It's just a UI UX. And it's not a web transaction, because I send it to you electronically using an app, but that's web too, Mark. Well, yeah, but then it leaves the web and goes into the banking system.
Yep.
That is not native. That is not digital. So what's going to happen in Web3 is we're going to have native currencies, Bitcoin and others, that will never leave the web. That transaction that you and I do will stay resident. Or I'll be in my car being driven, because we won't drive, and it'll pull into the charging station. I won't get out of the car and put a card in a slot and have it call, literally use a phone line or an internet line to call a bank and approve the charge.
Right.
That will not happen. The car will access a wallet and pay the machine. That will all happen on chain, on the web.
Instant
and
settlement.
that Web3 ecosystem. And all I'm really doing here is I'm just quoting this amazing book called The Spatial Web, where they outline this whole system that Web 1 and Web 2 are 2-dimensional. Web 3 is 3-dimensional. And that three-dimensionality means we can stay in the web space and interact and engage in commerce, and we don't need to go back out into the old world. Or as I said, fintech is 25 years of no tech.
Yeah.
It's just nothing new.
Yeah, I mean, instant settlement, right? And we can trust each other better without that middleman. So Mark, with that said, and BlackRock and Franklin Templeton and all these big names getting involved, Charles Schwab and Citadel and Fidelity launch a crypto exchange for institutional investors and much more. Do you think 2023 was the year of the a tipping point of institutional adoption? All the cards are on the table?
It's the year of institutional interest. 2024 is the big year. And look, I've been talking about this for 6 years. It's crazy. I've been talking about this for 6 years, that 54 was the mainframe, 68 was the microchip, 82 was the personal computer, 96 was the internet, 2010 was the mobile net, and 2024 was going to be this thing, the truth net. And what's the truth net? The truth net is the internet of blockchains, where the blockchains defined this spatial web and everything settles to chains. That we don't use centralized databases. We don't use centralized companies, where we don't have cookies tracking our information. We own our information. We don't use financial services companies that are outside the web to transact. We transact peer-to-peer using native digital assets. And 2024 was the beginning of that 14-year trend. So we're just beginning, right? We haven't even started the game. The national anthem's been played. The players have lined up. They're about to blow, the whistle here on January 1st. And then we start the game. And it's going to be a glorious game. Now, the next 4 years, like 54 to 58, like 68 to 72, like 96 or 82 to 86, like 96 to 00, like 14 to 18, I'm sorry, 10 to 14, they were all amazing.
Mm-hmm.
But then what followed every one? A crash.
Yeah.
Every time, because we got super ebullient, valuations got too high, and then we had a crash. But what came off the other side of the crash? Remember in 2000, 2001, 2002, massive crash, end of technology. The internet's done. Pets.com is a failure. Web band's a failure. You ever heard of Amazon or Chewy? Those are pretty successful companies. Yeah. Uber, pretty successful company. Apple, pretty successful company. They all emerged post the crash. So we'll go, 2024 to 2028, and we'll have this incredible period. We'll build a bunch of companies, and then we'll have a bust. And we'll have a crash, and people will say, I told you it would never work. It's dumb, stupid, too slow, and then we'll build on the other side the real infrastructure to make it invisible. Like right now, you and I are using TCP/IP.
Right.
To communicate in real time in HD. Like, how the hell does that work? I'm talking into a metal and glass box. It's going through the airwaves. You hear it in real time. There's no way that could work. We're sending it in different packets and switches, and they come back together, and there's no glitching. It boggles the mind.
Yeah.
But it's invisible. We don't think about it. We don't talk about, are we using an internet company today? Are we using a voice over IP company? No. We say we're Zooming, or we're, meeting, or doing a Teams or whatever. We use the technology for its intended purpose. We don't think about the technology.
Yeah.
We don't think about what a blockchain is or does and how it's different than a two-dimensional Web 2 solution. What we'll realize is, hey, I want to use my medical records for my own benefit, not for their benefit to sell my data to Merck to monetize. I get the advertising revenue to me. I say Pepsi could advertise to the day I die. I'm never going to drink a Pepsi because I don't like the taste of it. Yeah. Coke doesn't need to advertise to me because I'm going to drink Coke if I drink anything. So why don't they pay me directly? They don't need to advertise on television to have me buy a Coke. Just send me money and I'll buy Coke. So all of this kind of data flow is going to happen, but it'll be invisible to us. Right? You'll walk by your favorite store and you'll get a message saying, hey, we picked out that stuff you were looking at last night. It's all boxed up and ready. Come on, 20% off. Yeah, that works for me. So that will happen, but we won't talk about it. It will just happen. Exactly. And it'll be as transparent as all the technology we use today that didn't exist. Right? We all have uttered these words. How did our parents survive without a phone?
Right.
They actually survived quite well. They had very nice lives. And my dad still doesn't have an ATM card, literally. Because he's like, I can just go to the bank and get the money. Like, why would you do that? Why would you walk in a building and ask a person for money and just use a card? And in the future, you won't do that. You'll punch a button on your phone, and actually probably won't even be a phone. It'll probably be a hardware security module. It'll be a hard wallet that you carry around with you, and the phone will go the way of the dodo bird.
Yeah, I mean, just an incredible future we're headed to, a lot of benefits and so forth. Now, with regards to the Bitcoin Spot ETF approval, a hard question, when do you think those are going to be approved? I know there's some deadlines.
Second week of January-ish. Okay. I mean, do they push it one more time and go right down to the wire? I think the Ides of March, I think March 15th is the drop dead date. They either have to deny them or they are deemed effective. And I said, I think there's zero chance, when you should never say zero, but I think there's zero chance that BlackRock doesn't get approved. And so does it happen on the January 15th date, or do they wait till the March 15th date? I don't really know. I don't have any insight. But in both cases, it's before the halving, and you put that event in front of the halving. Ooh, fireworks, baby. I mean, look, we went from 10 to 60 in a matter of months, when GBTC was buying in the last cycle and Saylor came on and Elon was talking about maybe you could buy a Tesla with it. And then he changed his mind and went from 60 down to 30. And then Saylor bought more, and then we went back to 69. But that first pump from 10 to 60, when fair value was only 30, I mean, that was almost instantaneous. I mean, it was that same old. Everybody went home for Thanksgiving. They talked about it. People bought some more. Saylor came on TV. GBTC started pumping. I think $5 or $6 billion went in at a time when that market cap was much lower, and the rest is history. So is this one going to be bigger than that? Yeah, but we're starting with a bigger number. So the law of large numbers is hard, right? It's tougher to double a $700 billion asset than it is a $150 billion asset. Just is.
Now, with the Bitcoin Spot ETF approved, how long after you think we have to wait for an Ethereum Spot ETF? Because we see those applications being filed too.
Yeah, I think it's a great question. I think it might be almost instantaneous, right? I think the knock against them is the same, quote unquote, the markets can be manipulated, blah, 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 blah. No, it really has to do with the fact that the big banks love the fact that the futures ETF allows them to go naked short.
Yeah.
Right. And that's why we had this tremendous bear market. I mean, you go back to almost the exact day of the launch of the futures ETF was the top of the market in 21. Yeah. And look, if people can go naked short, they can manipulate the price. It's been happening in gold forever. Anytime you can create a paper asset with a futures contract, you have the opportunity to manipulate. So I will argue that commodities markets are more manipulated than Bitcoin market. And there are a lot of commodities ETFs. The VIX, oh my God, the VIX futures. I mean, that is a license to just rob people of their wealth. But that got approved and it's got billions of dollars in it. So plenty of triple levered ETFs, which are horrible. Just the way they even calculate the rebalancing just robs people of their money. And yet those got approved. So something like a Bitcoin Spot ETF or an Ethereum Spot ETF, both of which allow you to actually own the physical asset. How could you not want that to happen? And the reason is because by approving it, you're acknowledging that it's real. And the big banks don't want us to acknowledge that it's real yet. And look, we saw the announcement this morning that JP Morgan has got this new private chain to help asset management companies, eliminate back office infrastructure expense and lower fees. Okay, great, but it's still a private chain, and it lacks all the benefits of all the things we want in a decentralized world. And they made a big announcement and they're patting themselves on the back and that's all great. But decentralized is better than centralized. And a decentralized future is where we are headed, but not without a fight. So do I expect all the big banks to roll over? Do I expect them not to try to create regulation to slow it down? Like, the thing I am afraid of is the ETF gets approved, a bunch of money flows into it. They sop up all the excess Bitcoin, and then they say, you know what? Just like 1933, we're doing an executive order. It won't be 6102 this time, but some number. It's illegal to self-custody Bitcoin. Now, people say they could never do that. Oh, sure they could. Yeah. Just like they did it with gold, right? It was illegal in the United States from 1933 to 1975 to own gold as a citizen. Did plenty of people own it? Sure. Did everyone give it up to the government? No. Were they technically criminals? Yes. Could they have come into your house and taken your stuff? Yes. Yeah. But the average person doesn't own enough that they're going to do that. But the big dogs, they might be targets. And I do worry about that. I don't think it's necessarily going to happen, but it is a scenario that if I were devising Operation Choke Point, I would do exactly what they did, right? I would bankrupt the lenders, right? The people who were allowing people to convert fiat to digital, so the on-ramps. They did that really well through regulation and being in cahoots with FTX, which I think they were. And probably shouldn't say that out loud, but oh well. And then you got this issue of, okay, what would I do next? Well, I would threaten regulation around exchanges and other forms of access to the asset, right? If you wanted to outlaw stock ownership, what would you do? Well, you just close down the exchanges so no one could buy stocks. Really simple. Say, well, you could never do that. Sure, you could. They're private, and you could create a law that says, you create a law that they can't comply with, and then they have to shut down. So there's a whole bunch of things that could happen. I'm not saying they will happen, but we need to be vigilant. And the difference is decentralization is truly global, right? It's a nation. It's a non-nation state. It's borderless, and it exists in this thing that we call Web3. And you can then be a citizen of another place if you so choose. And then you're not subject to the same laws. Now, that requires you to move and or give up your passport, which I don't want to do either one of those.
Right.
But look, if things got to a point where they're going to call me a criminal because I self-custody Bitcoin, I might go to Costa Rica. It's a nice place.
Sure. Yeah, I mean, and it's interesting because all the banks are launching crypto custody services now. I mean, just this morning, it was news out of Germany, the fourth largest bank there. They got a crypto custody license. BNY Mellon has a custody license. So it's happening. So to your point, we have to be vigilant because they're setting it up for these TradFi guys to come in and take over and to custody and offer trading services and much more.
Yeah, but always remember custody, just like a bank, is an abdication of control.
Yeah.
Right? I mean, I was an early Coinbase investor. I'm a Coinbase user. I have a Coinbase account. And people say, oh, how can you do that? It's not your keys, not your coins. I know. I support the company because I invested and they were good to me. And it's easy. But they're not your coins. Like, I know that. And just like my money in the bank is not my money. I learned that the hard way too, right? The first time I tried to buy Bitcoin at Coinbase, Bank of America said, well, can't do that for 14 days. Like, what do you mean 14 days? And I'm like, well, that's what we can do. Didn't you read the fine print? Like, of course I didn't read the fine print. So that's their prerogative because it's their money. And I have an IOU, but they don't have to honor it for 14 days. So eventually they did, and eventually I got to buy my Bitcoin. So could governments put pressure on custodians to say, nope, you can't honor the withdrawals? Sure. I mean, right now, there are limits on what I can withdraw from my current bank because I left Bank of America because I don't like them very much. And my new bank, so they'll only let me transfer a certain amount of money, my money, but I can only transfer a certain amount per week.
Yeah.
Like, really? Really?
Yeah.
So what does that mean? That means I'm going to put less money in the bank, which is antithetical to what they want. And I'm going to have to go find other places to, have more freedom with my currency. But first world problems, not third world problems. The opportunities in the third world are much, much bigger, much better, much more robust. Things like remittances and the amount of theft that occurs in remittance companies that can be solved with digital assets.
Yep.
All of that is just so bright for the future. And the financial inclusion of billions and billions of people who are unbanked around the world who can do financial services transactions using their mobile phone in digital assets is extraordinary. And, okay.
I was going to ask you on that note, because we saw PayPal launch a stablecoin and we see USDC is branching out to different regions, and Tether, being the largest stablecoin, still has the dominance. Do you anticipate other companies launching stablecoins? And to your point, it's going to help with financial inclusion, remittances, moving money, and so forth. What are your thoughts on the stablecoin wars?
I mean, sure, others will launch, but like most things, it's really about brand and trust. And so there's a reason that certain assets become large or certain technologies become large, because they earn people's trust. And it's really hard to break into that. I'll give you an example. The twins, Gemini, have a stable coin, and it's perfectly good. It's perfectly good. Again, we're investors, and I like it, but not that many people like it because it's got small volume and it's not as robust, and it just never got that trust that USDC got. And so I think it's hard to break in to the when somebody dominates a particular one, because stablecoins are not rocket science. Now, what I think is going to happen with stablecoins, and you saw this in the UK just said, if you want to issue a stablecoin, you've got to deposit the assets and fully reserve them at the central bank.
Yeah.
Wow. I mean, that's big. So that means Tether ain't going to qualify for that.
Right.
I'm not even sure USDC would qualify for that. So what does that mean? Well, that means in that world, there'll probably be a leader that emerges. But again, if it's on deposit with the central bank, is it truly decentralized? I mean, it's kind of centralized on centralized. It's kind of like centralized squared. So I'm not sure it goes the right direction.
Yeah, it's fascinating. And we'll see how the governments, especially here, I'm very curious what happens here in the United States. We see the SEC subpoenaed PayPal to learn more about what's happening. And with the CBDCs coming, how is that ecosystem going to coexist, right?
Yeah.
These two, and are they going
to the governments would rather you and I transact in CBDCs because they can control it, they can monitor it, they can surveil it, they can program it so that we can't use it the way we want. I mean, the problem with CBDCs is just the dystopian nightmare of, you get paid on Friday, you go out and have a couple cocktails, you drunk text about the president, and your money's worth 75 cents on the dollar the next day. Or Target pays the government a little something, and your money doesn't work at Walmart anymore. It only works at Target.
Right.
That could never happen. Sure, it could. Of course it could. I mean, it wouldn't be ethical or moral or anything, but it could certainly happen.
Yeah.
And would there be uprisings? Sure. But at the end of the day, there are incentives built into our system. Like, think about home ownership. If you buy a house in the United States, you get to deduct the interest. If you buy anything else, stocks on margin or consumer goods on credit, you don't get to deduct that interest.
Right.
You used to, but not anymore. Why? Because they're trying to steer you in a certain direction. Yeah. And so you can build in incentives to achieve any goal that you want. So could they make money function the way they want you to function? Like, your money's only good for a week. If you don't spend it in a week, it vaporizes. Oh, they could never do that. Well, they kind of do that now. It's not a week, but by printing more of it and devaluing it, the same money doesn't go as far tomorrow. So they're encouraging what? They're encouraging consumption. Why are they encouraging consumption? Because post-World War II, we lost our manufacturing dominance and we became a consumer economy. So if you want to, make people consume, what do? You keep them afraid and you devalue their currency. That's how you make people consume.
I want to touch on crypto regulations because there are a couple, I'm coming up on time, but there are a couple bills in the House. They were marked up. There's also one or two in the Senate. What is your outlook? Are you optimistic that these can make it through before the whole election madness?
Look, Ms. Warren has a very evil agenda financed by, big financial services companies. So I hope anything she's part of gets defeated. And I think we have some good leadership like Senator Lummis and others that are fighting against that evil. I hope for stalemate, actually, right? I mean, the problem with the legislation that's being proposed right now, it's crazy stuff. Like literally, making self-custody, illegal. I mean, that hasn't made its way into a bill yet, but people are talking about it. And there's things that they could do that would make it really tough for the technology innovation to really shine. But that's not new. That's what every incumbent tries to do through lobbying. Lobbying is just a fancy word for corruption.
Yeah.
And, we talk about all the corruption in all the other countries. I'm like, well, what about all the lobbying, right? It's literally corruption. You're buying influence. You're buying events. I talk about way back when my family was involved in cable TV, and my dad, along with all the other small cable operators, suddenly faced regulation called the Re-Regulation Act, which basically said they all had to become addressable, meaning they had to make the cable boxes two-directional. Huge capital and they didn't make enough money to do that, so they all went bankrupt. Literally, they all went bankrupt.
Wow. And
John Malone came in and swooped them up and bought them for pennies on the dollar. And then magically that bill got repealed. Guess how that happened, right? And he never made them, later made them addressable. But it's a game that's hard to win for the little guy. But ultimately, the good technologies do win. It just takes time.
So Mark, what we're seeing, though, the checks and balances come into play here because Elizabeth Warren is working with Gary Gensler in the SEC. We've seen this. He's kind of the pit bull on the leash. But the SEC is taking a lot of losses in court. Certainly in the Ripple case, Ripple won the lion's share of that. Yes, the SEC won a small part, but the grayscale victory was huge, calling the SEC arbitrary and capricious. And then it looks like Coinbase, they may win this. So what are your thoughts on those losses racking up? And it seems it's taking the wind out of Gary's sails a bit.
I couldn't agree more. And look, the nice thing about court decisions is they set precedent. So I don't think they, meaning those on the other side, really thought through the scenario of losing. I think they really thought, look, we're in charge, we're going to win, and this will be great. Okay, but if you don't win, it's not just the loss, it's the precedent that gets set that future people can point to when you try to block them using the same approach. And so it's great for the industry. And I think the losses are much, much bigger than people think in terms of that precedent that gets set. And look, I don't think Gary's in for the long term anyway. I think there's likely a sea change coming, and he's probably aligned with not the people who will get to make those decisions. At least, that's the way I see it. But we'll see. And I definitely wouldn't bet against the incumbents right now, other than, and what I mean by that is we're not going to win overnight. We're going to win. And I've talked about this for a while, that this is the famous quote, from Mandela, that he actually didn't say, but someone attributed it to him, that, first they ignore you. So from 2009 to 15, they ignored us, right? Bunch of nerds and geeks with your magic internet money. Yeah, knock yourself out. Then they laugh at you. So 16 to 21, they're like, ha, 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 a bunch of nerds and geeks. Yeah, whatever. Then they fight you. 2022, and I think to 2027, which is interestingly right around the time of that bust that I talked about in 2028, I think they're going to fight really, really hard. So, the next few years are not going to be fun in that regard. And we're not going to just win, but we all know the last part of the clause, which is, and then you win. So if you're here, I think we've already won. It's just going to take some time, and we just got to keep stacking and keep building and keep focused on the future, and keep having conversations like this to keep people energized and excited about the space. So I appreciate all you do to help educate the masses and keep that positive energy flowing.
For sure. Final question here, because I know you got to go. Morgan Creek, have you added any new crypto companies to your portfolio? Any new coins?
So yes and no. So we just did the first close on our fourth venture fund, and the way our funds work, we can invest up to 30% in liquid protocols, 70 to 80% in the equity of businesses. We haven't made any investments in the new fund, but we are looking at 2 equity investments. We've been talking recently about liquid protocols. We'll always own some Bitcoin because to us it's the king. We like Ethereum as well. We've been looking again at Solana. We were early investors in Solana. We sold most of it, but we still have a nice bag that's gone up 6 times in the past 6 months. So that's good.
Yeah.
I think there's some interesting things going on there. I'm intrigued by decentralized storage. I love IPFS. I'm still struggling a little bit with Filecoin and the relationship of real data in storage versus people who are just mining the coin. But I do love the idea of decentralized storage given the data problems we have. And so I've been looking at that, but we haven't pulled the trigger yet.
Got it. Mark, always a pleasure, my friend. Always great insights. Thank you so much for joining me.
Well, thanks for having me on. I will talk to you again soon.